Look, we've just had the latest, David Einhorn, coming out saying, I'm worried about the sheer scale of AI infrastructure investment at the moment and that billions is going to be lost in terms of capital. What are you thinking of these warnings around a bubble?
Yeah. It's clear we're seeing explosive demand growth that we've really never seen before. That doesn't mean it's not real, but it does mean that we should continue to really look at these valuations and perform these sanity checks. And what gives me some confidence when I'm performing my sanity check is that this infrastructure wave, as significant as it is powered by real demand growth that is already showing up in the numbers. It's funded by real cash flows. And even after all of this enormous spending, the four major hyperscalers, they're still free cash flow positive. And so there's a lot of demand and still the supply constraint on infrastructure is there. So there's no like house of cards underneath this AI infrastructure wave, I'd say. But still, I think the AI theme it's a long-term one. DeepSeek was one upset that we had earlier this year. There will surely be others. And right now we're in this kind of period of digestion. But I think we're just waiting for that next piece of like bullish commentary and data. And then we're going to appreciate the fundamentals once more.
Stephanie, every phone call I get at the moment about a specific infrastructure deal, there's an element of debt involved.
Yeah.
How closely are you tracking that, and are you worried about it?
So the infrastructure spending boom is beyond just those four major hyperscalers, right? That fifth in line came out with a bond deal this week. So we are seeing that AI is going to cost a lot of money, and the debt markets are coming in to help fund some of those gaps in spending. I'm not incredibly worried about that just yet. I mean, the bargain that bond investors are making is that there will ultimately be enough revenue generated from this to pay back the bonds. That's maybe a more conservative bet than what equity markets are making by putting more money into these leading mega caps that already have sky-high valuations. But more broadly, I think it just shows that this infrastructure wave has a lot of urgency behind it, and it's beginning to touch many other corners of the market. The corporate bond market is one of them, but we're also seeing it in utilities and infrastructure and public and private and so forth.
I mean, a 40-year bond with, ended up a yield of just about 1.65 percentage points over treasuries. Feels like, relatively little to have to pay for the price of that longer-term debt. But there is belief. I want to go back to the comment you made, this isn't a house of cards. How do you feel, though, about some of the circularity arguments that are going on? That basically it's the same people who are buying, basically giving money in equity for promise of buying their GPUs later.
Absolutely. Markets have been rewarding large capital spending commitments, and we should not be rewarding redundant capital spending commitments. And I think that is one of the, the sanity checks that we've all performed this week is, okay, it seems like capital is sloshing from one balance sheet to another balance sheet. But a lot of the comparisons that are being made to the dot-com bubble of companies selling banner ads to one another, trying to juice up their valuations. What's different this time around is the spending is grounded in real infrastructure, real chip spending, real data centers. And so that gives me a bit more confidence on that. But we, absolutely should not be rewarding companies for redundant capital spending commitments.
Stephanie, really quick, can the global energy sector meet the demand?
That's the million-dollar question, right? Billion to trillion-dollar question, I guess. The reality is it's going to take all hands on deck. And while a lot of data center power commitments have been made, in fact, this year, enough to power New York, Chicago, and LA for a year. That's the degree of power commitments that have been made. A lot of that's in the pipeline. The reality is we are confronting a very aged infrastructure grid. It's going to take time until the 2030s at minimum, until nuclear power or even new natural gas power is going to be there. In the meantime, there's hope that we can get a lot more efficient and that the demand it's tracking up, but it's also tracking up gradually, right? So we're not too worried about that real, I think, bottleneck moment happening. It seems a few years into the future, and until then, maybe we see more efficiency gains. The costs of compute have come down 98% already.